We will be presenting this physician's financial checklist, going over investments, estate planning, disability insurance, life insurance, retirement, everything you guys need to know. We're the Peruvian American Medical Society, a charitable organization that was created by Peruvians who were living here in the US. And their goals were to improve the health of the people most in need in Peru, and also to share what they were learning here in the United States and improve the medical education in Peru. We continue doing 15 to 20 medical missions every year. Some of our missions have been virtually at this point, but of course, now as of March, we started in person as well. And we are now doing a blend of virtual activities as well as in-person activities. And of course, this coming year in 2023, PAMS will be celebrating their 50th anniversary. And if you want to learn more about PAMS or becoming a PAMS member, you can check our information at pams.org. So thank you so much for joining us today. We have two individuals with vast knowledge in the financial world, and we're hoping that this will at least open the doors for some information. And we are planning to also put together additional webinars regarding finances in the near future. We would like to present to you Luis Strommeyer. Luis is a partner and wealth advisor at Octavia Wealth Advisors. He specializes in clients with sophisticated approaches to their financial well-being. He is an expert on international and ultra-high net worth medical professionals, executives in mid to large domestic companies. Luis has a Bachelor's of Arts in Economics degree from Indiana Ball State University, and he also attended Ohio State University and did postgraduate work at Wright State University. And along with Luis, we also have Jordan Colman that is also joining us today. And Jordan is also a wealth advisor with Octavia Wealth Advisors. He designs successful strategies for clients' investments and asset protection. He assists individuals and business owners feel more comfortable, confident about safeguarding their families and realizing their goals. His expertise in public pensions and retirement plans, and he has a bachelor's degree in economics from San Diego State University. So Jordan, if you're ready, let's get started.
All right, I think Luis is going to kick us off. Luis.
Fantastic. Thank you, Jordan. And I'm going to say this in Spanish. Si tienen algunas preguntas, obviamente las pueden hacer al final de la presentación. Yo hablo español, soy peruano, nací y me crié en el Perú y estoy trabajando con PAMS desde 1994. So I just wanted to say that in Spanish. Now I'm going to turn over to English. First and foremost, our relationship from Octavia with PAMS extends all the way back since 1994. I've had a very close relationship by managing the investment, basically the endowment fund for PAMS ever since. And I sat on the investment committee for PAMS, I believe, probably going on close to 20 years. It's been a long time, ever since 1995. So anyways, it's been a long and rewarding time with PAMS, and we continue that to do so. Should I let you guys know that our firm, we do this without any charges to PAMS, so it's all again without any cost to PAMS to do this because we want to help and we believe in what PAMS is all about and what they do and the impact that they have in Peru and the health of the citizens of Peru.
And thank you, Luis. I have just heard so many great things about your firm and your commitment to helping Peru. And as you being Peruvian, I know that you do it with all your heart, and thank you so much for all the work that you do, because our doctors don't have the expertise that you have in the financial world. So thank you again for your commitment to PAMS.
Oh, you're welcome. So thank you so much. And so anyways, I just wanted to start and give you a little bit of an agenda. So first, we're going to introduce you to Octavia, who we are, what we do. We're going to talk a little bit about retirement planning, investment strategies, risk management, estate planning, and then there's our Q&A. And again, if you have questions in Spanish, just go ahead and send those out or ask them directly. I'll be happy to answer those. And if Jordan wants to practice his Spanish, he can do that too. So anyways, let's get it going. So let's talk about Octavia, and our comprehensive team approach. So certainly the way that we when we set forth and started Octavia, we wanted to create a team in a collaborative approach with experts in different fields. So we have retirement planning, investment management, insurance planning, tax planning, business planning, estate planning. And basically, everybody in the firm is like a law firm. Everybody in the firm has a different expertise. And that's how we can make a very comprehensive approach to our clients. So our clients don't necessarily work with one specific individual. They work with a team. Now, certainly they may be talking to one individual at the forefront as a relationship manager, but then there's several people behind the scenes that are helping the relationship manager work with the advisor, work with the clients. And that's kind of the way that we design Octavia from the get-go. Again, we are a fiduciary servicing company. So we are all fiduciaries. Jordan is a fiduciary. I'm a fiduciary, and every advisor at Octavia is a fiduciary. What that means to you is that we are looking out for your best interests. And that is by law, not by design. So just like when you work with your attorney, he operates as a fiduciary, or a trustee operates as a fiduciary. We, again, operate as a fiduciary for you. So we work for you, not for anybody else. Again, everybody at Octavia is a professional with many different certifications and designations: certified financial planning, certified financial analyst, certified divorce financial analyst, chartered life underwriter, chartered financial consultant, and so forth, as certified public accountant, and so forth. So a lot of our advisors hold multiple designations in their area of expertise. And again, we manage everything on a proactive basis. We have investment committees in the company, trying to figure out the best allocation and the best advice to provide on investment portfolios. Again, we also use tactical ways of and dynamic ways and different approaches to your investment methodologies. As far as alternatives and infrastructure, we have what is called an open architecture platform. So literally, we can get anything under the sun that we need to provide service to our clients. We're not married to anything in particular. Like I said, we'll work for you. We don't work for anybody else. And let's see. And then again, our wealth management team, you are at the center. So we call this a client-centric model. So you have a team of experts that surround you, and we provide, obviously, the best service that we can do for our clients, always looking out as the center of the relationship. And then we go out and procure whatever is needed from the necessary experts. Now, as far as the tech stack, and we have access to multiple technology platforms that we can utilize for planning. Some of those names are identified here. You may have heard of them, you may have not, But again, technology, we leverage technology to be able to help you in the best possible way. So we're not afraid of getting our hands dirty when it comes to technology to provide the best integrated approach to your financial needs. And as far as your money, where does it reside? The main point that I want to say to you is your money is not with Octavia. So again, as fiduciaries, we don't want your money to reside in our firm. We want your money to reside at a trusted custodian. So that could be Schwab, could be Bank of New York Mellon, could be Fidelity, National Financial. So we have multiple, we call custodians. That's where your money is. So we are literally the advisor on your monies, but we don't have access to your accounts other than from advisory standpoint. And these are our offices. We are in Cincinnati, Dayton, LA, Miami, and San Diego. Those are our actual physical offices, although most of us are licensed in many states, so we can serve you. We have clients literally in probably all 50 states. So there's somebody that is licensed in your state if you need to talk to us. So with technology today, we can work with anybody. We even have international clients. We have a lot of clients in Peru, in Colombia, Mexico, Europe. So again, it doesn't have to be in those specific geographical areas where we have an office. And now I'm going to turn it over to Jordan, and he's going to guide us from this point forward. And again, you might hear from me at the Q&A. So I'll turn it over to our expert, Jordan. He's been with us for, well, he's been in at least over 12 years now, Jordan.
That's correct.
And been with Octavia since the inception. And I have a lot of confidence in Jordan. We have a lot of clients that we work together. I have a lot of joy working with him, and he certainly is the right person to talk to when it comes to retirement planning. So here we go, Jordan, take it on.
All right, thanks, Louis. All right, so for everyone, we're just going to start off here. We're going to go through retirement planning first. So it's going to be a broad overview of different types of retirement plans. We'll talk about different strategies that you may be able to implement for your practice and for your family and for yourself. So we're going to dive right in here. So we always like to talk about different myths and then kind of the reality check between things, right? So let's talk about some common retirement myths. So you got retirees happily leave their jobs at age 65 and never work again. Well, 21.5% of men and 13.3% of women over the age of 65 still work today in the US. The other one would be Social Security is a complete retirement plan. Social Security represents only 64.8% of the aggregate income of people age 65 or older. And I imagine if you're a physician, right, that number is going to go down a little bit more than that. I'll need only 70 to 80% of my pre-retirement income during retirement. 52% of retiree surveys spent 95% or more of their pre-retirement income during retirement. So, what does that mean, right? That means you need to start participating in your retirement programs, right, that are available to you or that you can set up for your practice. So there's really a couple of different retirement programs. We'll start with the most common that we find in the medical field, which is 401ks and 403bs. There's really two different types of 401ks and 403bs that you can have with your practice. There are Roth 401ks and 403bs. And the way that those work is you take after-tax contributions, they go into the retirement account, they grow tax deferred. And then when you pull them out in retirement, they come out tax-free. So, these are very advantageous for someone who may not need major tax breaks or is younger in their career, wants to take advantage of, their lower tax bracket now. And then when they're in retirement, essentially might be making more money. So they get to pull that money out tax-free. So we see a lot of that working for those individuals. or for someone who might be making too much money, doesn't need some tax breaks, and essentially cannot put into a Roth IRA. Those are really strong solutions. Traditional 401k and 403b contributions, as it states, it's very traditional. Money goes in before taxes. So allowed to kind of leverage that by, essentially saving more, right, and feeling less off your net paycheck. It does help with tax deductions. So, anything you save into one of those types of traditional programs will lower your overall taxable income. Again, the contributions grow tax deferred. And when you pull them out, unlike the Roth, you do get taxed. So, if it's one thing that's certain here is, you're going to pay your taxes. It just kind of depends on which end you're going to pay those taxes, right? Now, the annual limits for these plans are a lot higher than traditional IRAs and some of the other plans we're going to go over. So the contribution limits this year, $20,500. And then if you're over the age of 50, you can put an additional $6,500 into them. The maximum from an employee contribution standpoint, as well as the employer side contribution, is $61,000. It doesn't include that $6,500 catch up. So if you're over 50, if you're putting in your contributions as an employee, but you're the owner of the business and you do some form of matching or profit sharing, you can also increase that amount while also getting those deductions for the business. There are no deduction phase outs due to your adjusted gross income, no age restrictions for your contributions. And then in these types of plans, you can add loan provisions if you ever want to access money while you're in your working years. Some of the other plans that are out there, simplified employee pension plans, those are SEPs. All contributions to these are pre-tax. You have to contribute. You can contribute up to 20% of your net income if you're self-employed, contribute 25% of employees' total compensation. Max limit on this is also $61,000. There are no loans. Big drawdown to SEPs as opposed to 401ks. If you put in a SEP contribution for yourself and you have employees, you have to put the exact same amount of percentage into that SEP for yourself. So this kind of can be a costly plan. So traditionally we see if you're like a single, physician practice or maybe a husband and wife practice, this might be a good plan for you. Again, consult with us. We'll help kind of design the strategy for you. And then lastly, if you're just trying to get into something, hey, I want to offer a plan, but I'm not ready for, the 401k plan. There's simple IRA plans. Again, all contributions are pre-tax, so there's no Roth option. The contributions are a little bit less, starting at $14,000 max, $3,000 catch up for if you're 50 or older. Now, with the simple plan, the match is required. There's either a 2%, what's called a non-elective match, which means that regardless of whether you or your employees contribute to the plan, you will have to contribute 2% of their overall W-2 salary into the plan. Or there's a 3% elective match, meaning that your employees as well as yourself will have to contribute up to that 3% mark to get that match. Again, no loans. So this slide right here talks about the power of tax deferral. So whether it's the Roth 401k or the traditional 401k, you do get tax deferral inside of your account. So what that means is in these types of retirement programs, let's say that you're moving around your positions, maybe you're heavier stock in your earlier years, and then you want to switch over to maybe a little bit more fixed income, safer investments as you get closer to retirement. Anytime you make those investment decisions, there are no taxes that are happening. And so because of that, right, your money is not getting hit along the way. And so you can see from this graph, as opposed to an investment account over time, because the investment account, when you make those changes, you do get hit with capital gains tax most of the time. The account value tends to get affected. So, again, we always are big proponents of having multiple buckets of wealth, but this slide right here just kind of shows you the power of tax deferral over time. And then we just kind of wanted to show you a hypothetical example for a couple of reasons. It's never too late to save, right? So that's always the big question that we get asked. I'm later in my career. Is it too late to save? The answer is no. any money saved is obviously, money that's going to earn for you in the long run. And so we gave kind of a hypothetical example of a physician saving $1,000 a month, so $12,000 a year at different rates of return over different time periods, 10, 20, and 30 years. So we've got someone saving over 10 years in a conservative portfolio, which would be right around 5%, a moderate portfolio, which would be around 7%, and then more of an aggressive portfolio at 10%. And you can kind of start to see as you go through the 10, 20, and 30 years, the power of that tax deferral. A moderate investor, someone middle of the road, right? Essentially saving that amount of money over a 30-year time frame has over $1 million. Someone a little bit more aggressive has over 2 million. So again, never too late to save. Obviously consult with your advisor when it comes to the risks that you're comfortable taking and the investments, that are going to get you to achieve your goals. Roth IRAs. So some of you may qualify for a Roth IRA, some of you won't. If you don't right now, due to your income, we're going to talk about a strategy here at the end of this slide called the backdoor Roth. But if you are within the income limits, you can fund a Roth up to $6,000 per year if you're under the age of 50, $7,000 if you're over the age of 50. Again, after tax contributions going in, tax-free distributions when they come out. If you don't qualify for a Roth, again, consult with us. We'll help build a plan for you. You could use some of those plans that we previously discussed to lower your taxable income to get you within the range to be able to contribute. But if you don't have that ability because you're making too much income, there is a strategy called a backdoor Roth where you essentially make a non-deductible contribution to a traditional IRA and do a Roth conversion within that year. And so there are ways of getting funds into a Roth IRA if you are a high income earner. We do it all the time and we specialize in it. All right, so I'm going to move along now into investment strategies. So we're going to talk a little bit high level on the different types of investments that are out there and give you a brief education into alternate asset classes that we believe are going to be advantageous given the current economic environment that we see ahead over the next decade. So I kind of alluded to it a little earlier on that 5, 7, 10% slide about compound interest. There's different risk preferences that you're going to have, and then there's an entire gamut of investment options that are available to you. You have your more low risk investments, cash, bonds, kind of a little bit of a wavy one this year with rising interest rates. And then you go to your higher risk positions like individual stocks, commodities, and then probably more traditional investments that you're used to hearing about, mutual funds, which is a group of stocks and bonds, or exchange traded funds, which is also a group of stocks and bonds, more so though in a exchange traded fund wrapper, a little more tax efficient, and then structured notes and alternatives. So again, like Louis alluded to, we have the entire gamut. We're highly educated on all of them and how they could fit into your needs. And then when it comes to the different risk preferences that you are, again, depending on where you are at different stages of your life, depending on what you're planning for, whether it be retirement or buying a home, second home, whatever it may be, right? There's going to be different risk preferences. Again, consult with us. There's an entire gamut all the way from very conservative, which is capital preservation, all the way to hyper aggressive. And really what that is just a balance between your positions in equities as opposed to fixed income alternatives, things of that nature that would dictate the differential of how you allocate yourself. So one of the things we thought would be extremely valuable for all the PAMS members to hear about is a lot of times there's a lot of information that goes on in the news, and it talks about what happened in the past and where are we going moving forward, right? And so we're fortunate enough to work with a firm that called Fiduciant that analyzes all the different areas of the market all the time. And so what you guys are looking at here, essentially at the top, is all the different public markets and how they did over the last 10 years. And if you guys have been invested in the stock market over the last 10 years, you've kind of felt it in your account. You know, US equities really drove the way, did incredibly well over the last 10 years, of up 16.2%, almost double what it's done ever since its inception. It was a phenomenal decade. International equities lagged a little bit at 7.4%, corporate bonds right around 4.6%, and then government bonds, you know, right around 2%. But where are they going moving forward? So what you're seeing on the bottom are actually projections, not from just Fiducian, but also our peers. So BlackRock, which is one of the largest money managers out there, BNY Mellon, one of the largest private banks, Invesco, another really large money manager, and Vanguard, which a lot of people are very familiar with. So what you're seeing moving forward is the projections are not as bullish, we would call it, or positive when it comes to the overall returns in US markets, right? So Vanguard as low as 3%. I think Invesco has them as high as 7%, nowhere near the 16.2%. And then if you actually look over to international equities, you can see that actually a lot of the money managers or our peers are feeling like international equities are going to outperform US markets. That's due to various factors. Obviously, we're in a high inflationary environment. US stocks have significantly outperformed international over the last 10 years. So valuations on those stocks are very low relative to US stocks. And so again, you know, when you're positioning your portfolio, you want to make sure you have a well allocated portfolio so you don't miss up on the run-ups in those different markets. And then if you look at fixed income, it's looking pretty bleak. Fixed income doesn't do very well in rising interest rate environments. So again, we're going to educate you guys a little bit on alternative asset classes and how to combat that, you know, inside of your portfolio. But, you know, with inflation being where it's at, we project it to be anywhere between 4 to 5% over the next 10 years. And so if your bonds are earning you sub 2%, that's just not going to cut it. And then those same projections up against private markets. So, you know, we're big proponents in believing that, you know, you need to have a good chunk of your asset allocation to public markets, but also the private markets offer an opportunity for you essentially in two different regards. One, you don't have as much correlation to the public space as you do in the private markets. So, you know, where there's a lot of volatility in public markets, it doesn't mean that private markets are going to also experience that volatility. Essentially, the implementation strategy is a little bit more long-term. And so, you know, we find that the rates of return in these types of strategies can be less volatile and not compromise the return. And you can kind of see that in the projections moving forward. Fiducian expects private equity to about 8.9%. BlackRock really feeling good about private equity at 18.7%, BNY Mellon at 7.9%, and then also private real estate, right? So these are across different asset classes: industrial, multifamily, office. And so, you know, 6.4% for Fiducian, 6.4% for BlackRock, BNY Mellon, and Invesco at 8.1%. Again, also really tax efficient distributions on the income side when it comes to the private real estate, because of depreciation and the way that they distribute that capital to their investors. So, you know, again, I've been kind of throwing this term out here, alternatives. That would be, you know, essentially those private market investments. And this is just a graph that illustrates, right, someone, you know, who might be aggressive or moderate or conservative. And what happens if they add 30% of these alternatives into their allocation? And so what you're looking at here on the left side is the annualized rate of return, so the performance. And then on the bottom there, you're looking at annualized volatility. So the further right you go, the more aggressive; the further left you go, the less aggressive. And so what you're seeing here in an aggressive portfolio is you're seeing that box essentially shift over about 25%, or excuse me, almost 30% less risk, little higher rate of return. So almost, you know, again, 30% less risk, right around the same amount of return. But then look at these boxes for moderate investors or someone who's conservative. You can see that those boxes start to tilt, especially on the conservative side. You're moving down the gamut just a little bit in risk, maybe 10 or 15%. but the return is also going up 10 or 15%. So in a rising interest rate environment that we're in right now, where bonds are not as safe of an investment as they used to be in the past, these alternatives can provide a safe haven and keep your portfolio growing for you. And then this is just, a list of the different types of alternative investments that are out there. So, you have hedge funds, which essentially will, take the public securities or the stocks, and they'll either bet for them or against them. And the whole concept is to kind of hedge your risk. You've got private equity investments, again, investing in private companies, venture capital. So the big difference between, I would say, private equity and venture capital, private equity tends to invest in later stage companies that are a little more established, that have, kind of growth ambitions to potentially go public, or have been around for a long time, that have a proven track record, right? That still have upside for growth. Whereas venture capital is really more early stages of these companies. And so I would say the risk in terms of venture capital relative to private equity is a little bit higher. Alternative credit. So this is where, essentially fixed income comes into play. So it gives you access to non-traditional investment grade corporate or sovereign debt, high yield bank loan, structured credit. So again, good bond alternatives. Structured notes, which are vehicles that provide you downside protection from the markets while giving you either a fixed income payment or a growth feature. Tremendous tools. We have models here at our firm that either use them or don't use them, but we're a huge proponent of those structured notes. And then private real estate, like I hit on a few slides ago. So, again, we're huge proponents in this space. We do believe that adding them to your overall asset allocation is not only going to benefit you in the long run, but will also make the ride a lot smoother for you, especially in volatile markets like we're experiencing right now. So I know that I'm going through these slides very quickly. We have a lot of stuff to show you. So please, any questions that you guys have, please put them in the Q&A or chat. And like I said, Louis and I will go through them. Louis, did you want to add anything at all right now? Or are you good? Oh, I think you're on mute, Louis. Oh, no. All right.
Why ruin a good thing? You're doing great.
All right. Thanks, man. All right, so let's talk about risk management, right? So why is risk management important? Well, you guys are in this field, right? Things happen, right? Every single day, right? And, you don't know when things are going to happen, but they do happen. And you have to make sure that you're protecting yourself, your family, your business, right? And so, we're going to talk about a couple of different ways that you can do that. We're going to talk, there's property casualty and liability protections, there's health insurance, life, disability, and long-term care insurance. We're going to focus in a little bit more on the bottom there, life, disability, and long-term care insurance. So risk management, protect your single most valuable asset. So your single most valuable asset is not your house or your car, it's you, right? So, a lot of you, I imagine, are, the main income earners in your household, or, to a certain extent, if you're not around, right, your family may be financially hurting. And so you need to make sure that you're protecting yourself in that regard. There are different types of life insurance that are out there. The first is term insurance, and it is kind of what it sounds like. It covers you for a specific set of time, 10, 15, 20, 30 years. It's used for its affordability. There is not a cash value or investment feature. Your premiums are typically fixed for that period of time, and they may have a convertibility option there in the future. So, term insurance is used, to cover your mortgage, or to make sure you have enough coverage so that when your kids hit college. From a business perspective, they're phenomenal tools for buy-sell agreements, in case something happens to you and you want to make sure that your family is taken care of, so that they can buy out the business from your partner or vice versa. So, we see term used in that regard. And then regarding, more of an investment in the long run kind of scenario, if you want insurance over your entire life, there are what are called permanent policies. Different types of permanent policies. There's whole life insurance, which talks about guaranteed fixed premiums. Cash value growth is based on dividends. There's universal life, which you have flexible premiums later in the policy's life, and the cash value growth is based off of interest rates. Excuse me. And then you have index universal life, which is a newer product. Flexible premiums, your cash value growth is based on performance of index linked interest options. Your performance is capped. So, for an example, there might be an S&P 500 fund and the cap might be 10% for the year. If the S&P 500 does 20%, you get 10%. The insurance company takes the other 10. But for that cap, you do get protection, typically 100% downside protection. So if we're in a market like we're in now, and essentially the markets are down, you can kind of rest easy in that regard, knowing that your premiums are safe. And then for those clients that are a little bit more investment focused, looking for more of a long-term investment, there are variable universal life policies. Cash value growth here is based on investment options, very similar to investment accounts or mutual funds that you would see inside of your 401k plans. You have full participation in the market. One of the major advantages to permanent policies is you may have the option to add on certain riders, like long-term care services riders, which have been extremely popular for our clients. The way that they work is, essentially, let's say that you had a $500,000 life insurance policy with a 3% long-term care services rider. You go into long-term care. Once you start getting payments, essentially you can get up to $15,000 or 3% of that $500,000 per month to essentially pay for your care. It just gets taken from the death benefit. So again, example, on $500,000, if you took $100,000 to pay for long-term care and you pass away, your heirs would then receive a $400,000 benefit. Again, extremely beneficial planning tool for someone who needs life insurance as well as long-term care, as well as accelerated death benefit and critical illness riders. Disability insurance, again, as a physician, if anything happens to you, and you can't work, you want to make sure that, essentially paychecks are coming in, right? So, some just kind of a high level, statistic here, more than 1 in 4 of today's 20-year-olds can expect to be out of work for at least a year because of a disabling condition before they reach the normal retirement age. So 1 in 4 is obviously a high number. I don't have to tell any of you here, I'm sure you've seen a lot of individuals who've had, these types of hardships that have happened to them. We always recommend doing an analysis to see how you can protect yourself. And then lastly, long-term care. So we're all living a lot longer. There's been a ton of advancements in the medical field, as you well know. And so, 52% of people turning the age 65 will need some form of long-term care services in their lifetime. Over 30% will need care in a nursing home for some period of time. The average current cost of healthcare here in the United States, if you want a private room, is $297 per day or $9,000 a month. If you want a semi-private room, it's $260 a day, almost $8,000 a month. Those numbers may or may not shock you. They certainly shock, me at times, when I look at that, especially when the rising costs of those are unknown and typically indexed at right around 5 or 6% a year. You can start doing the math. And if you're not protecting your family, I just did an analysis for a client. And I mean, the numbers were absolutely ridiculous when you look 20 to 25 years down the road. If those costs index at 5%, we're talking millions of dollars in the future. All right, so estate planning. So, Lewis alluded to, we do take a comprehensive team approach. And so when we're working with our clients, right, we really focus in on financial planning and making sure that your overall financial wellness is taken care of. And that includes your estate plan. We would have thought during the pandemic that a lot more people would have really focused in on their estate planning. but still, you can see the statistics are pretty little changed. It's an area that, we really harp on for clients, especially, with the way that probate laws and estate law, tax laws are written, especially for high income earners such as yourself. But there are some common misconceptions, and I think this is why a lot of people don't do them. So, one of those would be, I need to be ultra wealthy to need an estate plan. No, you don't. It's an insurmountable task. No, it's not. Getting started is too difficult. There's a high cost to estate planning. Estate planning is only for the elderly. Look, if you have a house, if you have children, if you have a business, you need to have an estate plan. It's just as simple as that. We have professionals that we can link you up with to make sure that you can get on the right track. I personally have just gone through this process because I'm expecting a child, and I understand that you do receive a lot of paperwork up front. It is a little time consuming, but make the time. It is worth it. Benefits and importance of estate planning. You get to control the distribution of your assets, right? You get to make sure the right people get essentially, the types of assets that you want and when you want them to get them. Preparing ahead of time, as well as protecting your family members. So the importance of estate planning for your assets and your loved ones, right? So it's not just, you're doing this for yourself, but you're also doing this more importantly for your loved ones. So preparing relevant legal documents makes the transfer of your assets as seamless as possible. Will reduce or eliminate the amount of taxes paid at your passing, provides confidence that your assets will be distributed according to your wishes, and facilitates timely distribution of your estate. So here in the state of California, and really more focused in on San Diego, probate not only is expensive, but it is also time consuming. So I had an example of a client who, again, we tried to get an estate plan done for them and their family. They weren't able to get it done. A primary source of their wealth was in real estate. They didn't get a trust done. Essentially, the county said, hey, listen, we need these taxes in order for you to process the estate. They didn't have the funds to essentially do it, and the kids didn't have access to the accounts that they needed to because an estate plan wasn't properly done, and they had to go basically run an estate sale and a fire sale on their assets. Guarantee you that's not what my client wanted to happen, but it is what happened because that's just the way it works when you don't get an estate plan done. So please keep that in mind when it comes to estate planning. This is another one. It's the importance of sharing your estate plan and wishes with your loved ones. So, it's really important to kind of share, what you're really thinking with your children or your spouse or whoever it may be, that's going to be doing this. One, if you have someone who's going to be your trustee, at least they know what's coming, right? They know they can be mentally prepared for the responsibility and the role that they're going to take on. If you have multiple children, or if maybe you've been married once or twice and now you and your new spouse have children, you don't want them fighting, over your money. I can't tell you how many times it's really sad how we see that happen. So please do share those plans with your loved ones. It can help reduce confusion, stress, and conflict in the future, time of grief, by promoting honest and productive conversations with loved ones about your intentions. It reassures your loved ones that they know your wishes and can help to carry them out. And for you personally, it can put your mind at ease as well, right? Because now you've essentially verbalized what your wishes are, and so everyone is in the know on what's supposed to happen and when. So what goes into an estate plan, right? So this is all the list of documents that go into your estate plan. You have a will, trust, personal property disposal list, a living will, medical power of attorney, which all of you are very familiar with, and then a durable general power of attorney. An ethical will, family traditions, and family history can also be added. So it's very cumbersome. It's very detailed. And you can customize them specifically to do tax planning as well as gift out of your estate if you have a large enough estate. 2026, essentially the current estate tax exemption which is, just shy of 13 million for each individual. So 26 million for married couples. That is set to sunset in 2026. There's been some speculation on where that can go. If nothing's done, it will revert back to 5 million total. So that's a huge discrepancy, 26 million to 5 million. So we always recommend that you consistently update your estate plan and meet with your estate planning attorney. The laws may have changed, and there might be new strategies that could be available to you, or maybe your wishes have changed from when you originally did it. And so it's always good to review your plan. Common hurdles to having these types of discussions with loved ones. We don't want them to worry. It's too time consuming. They don't have enough knowledge on this type of thing. We don't want them to know how much we have. It might hurt their work ethic. All very, very valid concerns. Obviously, you know your family more than anyone. We're not here to pretend or tell you, essentially how to have these conversations. But I would encourage you to have productive conversations with your family for all of the reasons, that I was discussing before. So how can we help? Well, one, we essentially try to help lead or guide these conversations, for families to have with their families. It can be easy for this process to seem like a daunting task. So we're essentially here to help you through this process step by step in any way. We'll work with your estate planning attorney. If you don't know anyone, we'll help you out as much as we can, so that everything's in order. And then we do work directly, whether it's an estate planning attorney or CPA that we referred you to or not. They are a part of your financial team. And so we will work with them to make sure that your estate plan is set up correctly. And then we recently just launched our estate planning organizer. So if anyone wants these, we will definitely email them out. Essentially, it's just kind of a quick little starter kit. By no means is this an estate plan. So, I am not a lawyer by any means. Please do not fill this out and think this is an estate plan. But it is a good document for you to start so that when you do meet with your trust attorney, you can walk in the door and say, hey, I've kind of already started thinking about this. Here's what I'm thinking. And then you can be a little bit more prepared for that conversation. So, I think Luis and I just want to really thank you guys for your time today. I know, we breezed through a lot of topics. There's a lot of stuff in here. So I'm sure you all have some questions. So please type those into the Q&A or the chat, and Luis and I'll be very happy to answer them.
Thank you, Jordan. We'll turn it over to you, Maria.
Okay, well, thank you. So explain a little bit more about the tax deferral plans that you would suggest that our audience right now consider.
Got it. So I mean, it's all dependent on your individual situation, right? So when you meet with us, we will definitely identify what the right solution is for you, because each plan is unique and can have advantages or disadvantages depending on the one that you choose. The most common of which is the one we started with, which I think is a 401k plan, especially for physicians who are earning a pretty substantial income. It allows for a lot of flexibility in what you can do and what you can save. And for those of you who might already have a 401k plan, you're maxing that out and you're trying to figure out what else you can do, and you own your practice. There are things called defined benefit plans that you can put on top of those 401k plans that allow for even more deferral. So again, we wanted to provide kind of a high level overview. Like you said, Maria, this is the first exercise that we've done in kind of seminar. We are more than happy to break out into individual sessions and kind of dive deeper into any one of these topics for the PAMS members.
I know that one of the worries people have, and we have many members who are also retired, and we keep hearing, are we heading towards a recession? What is that going to mean for those retirement funds? What are your feelings in regards to that? If is a recession something we need to brace for? We've already seen the inflation that has increased not only here in the United States, but also in Peru. So what would be some things to consider right now?
Yeah, definitely. So it's a phenomenal question. It's obviously very heavily loaded. So I'll start with the first one, which is, really kind of as it relates to a recession. You know, I'd love to say that, essentially we've got, clear sunny skies on our horizons, but I think everyone would know that that's just not the case. Here in the United States, we're obviously raising interest rates. We are trying to cool off red hot inflation, right? And so the Fed is essentially raising rates. They're raising them very aggressively. And the ultimate goal is to, drive us into a recession. So, sometimes those can be actually beneficial when it comes to the way that, essentially the Fed sets it up. They're working on doing what's called a soft landing, where the economy doesn't get hit as hard. With that said, we are not in a recession as of yet. And so, fundamentally, there are still a lot of positive economic indicators out there, but, I do feel that the probability of us being in a recession here in the next 12 months is a lot higher than where we were at the beginning of the year. Fundamentally, on the stock market side, we've obviously had a sell-off. There's been a lot of volatility. If you would have come to me and said, China was going to shut down again, Russia was going to invade Ukraine, and we were going to go through, highest gas prices we've seen since the 70s, I probably would have laughed at you back in December. But that's the world we're living in. It's just been a really tough year. And so from the fundamental side in the markets, when you talk about in January, price to earnings on US stocks relative to international stocks were pretty high. I mean, they got overvalued. Trillions of dollars were pumped into our economic system here in the United States, and people weren't traveling. They didn't go out to restaurants, and they didn't want to keep the money inside of their bank accounts. And so what did they do? They either bought things and pumped it into the system, which drove stock prices up, or they invested into the stock market. And that drove prices a lot higher than they needed to be. And so now we're experiencing kind of that sell-off, right? Which is also healthy. It's also important to note that we do experience these sell-offs quite frequently. And so, price to earnings ratios fundamentally in the stock market are actually closer to their average, which means from a fundamental standpoint, they're pricing in pretty decently. Doesn't mean that volatility is not going to continue in the short run, but if you're a long-term investor and you're looking to, essentially invest over a 3-5 year time period, there is a strong probability of success, a very high probability of success. So, Louis, I don't know if you want to add to any of that, but that's a really good question, very loaded, but that's how I feel about it.
Yes, I can definitely just answer, but those were very good comments, Jordan. The part of the global economy, just to parlay into that, there is it's a contagion. I mean, the United States is about 23.6% of the global GDP. So it is the largest economy. Second largest is China, and it has a little bit more than 15.7% of the global GDP. So what you have seen is a slowdown in China and now a slowdown in the US. So just if we take those two countries and forget Europe, forget everything else, you have over 42% of the global economy that is slowing down. Not necessarily a recession, but it's slowing down. So if the US goes into recession, I think there's a very good likelihood that the rest of the world is going to follow suit. And I think that a couple of things to measure, talk about Peru and the situation in Peru. So there's also geopolitical issues in the region. So LATAM right now, everybody knows what happened a week ago in Colombia. It is, basically, it is a populist wave that is going through all of LATAM, pretty much, I mean, the largest economies in Latam, with the exception of Brazil, which they're having an election in the next 12 months, and it points to a populist win over there with Lula. So I think we pretty much can say that the region is going to be more of a socialist regime. So that causes tensions anytime. So from the political landscape, and also that increases the risk for slowdown, because foreign investments, don't get their way to those countries just because of the political tensions. So you have that going on. Then you have the invasion in Ukraine that is not helping matters in Europe and in Asia. So I think if we're gonna, what we think is going to happen, I think that the likelihood, the probability of a global recession is much higher today, like Jordan said, than it was 6 months ago. Now, can we say that we're going to be in a recession globally? I find it a little bit difficult. Just in 2020, if we use that as a measure, the GDP growth for the entire world was a positive 0.1. Now, let's just say no growth, right? Because the world was pretty much shut down. So even with the pandemic and all the lockdowns in all the countries in the world, we still didn't hit recession. So some countries did, but not the world as a whole. So I don't know about the world. The US, I think the likelihood is very high that we'll hit a mild recession. And if it'll come, it will be towards the latter part of this year, beginning of next year, and hopefully it shouldn't last more than 6 to 9 months. Now, there was a question from one of the participants about retirement. And I answered it privately, but the question is, if you have properties and you have 401ks, and if you have a certain amount of assets, can you semi-retire? Semi-retire is probably, and I think Jordan will agree with this, semi-retire is probably the best way to go about retirement. I think cold turkey is good if you want to quit smoking, if you want to quit any type of vice. But I think to completely shut it down is very difficult. I have retired probably over 200 clients in my career, and they're still with me. They're retired. A lot of them are actually members of PAMS. And the way that I have seen it most effectively is that they have semi-retired for a few years and then moved completely into retirement. Very seldom did I see a full retirement. Not to say that it hasn't happened, but I like the idea of semi-retirement, slowing down, as I like to call it, and I think that is the most effective way.
And let me go and put something in there, which is really interesting. I've been getting emails from doctors that are looking at retiring, who have not been PAMS members, and some of them who now, because they're retiring, they're like, I have more time to go to Peru or help with missions. So one of the studies that I read about is, for people that do retire completely and stop, that many times there's a lot of isolation and depression and things like that, because they're no longer doing their life's work and they're not longer involved. So I know I've seen so many of our PAMS members that retire and then they turn their whole focus to working on a mission or things like that. So you're right. It's like, sometimes it's more damaging to just give it up completely, even from their practice as well. Individuals, regarding their life insurance, when is it too late to get life insurance?
Well, it is too late when you're not healthy anymore. But I think we have had clients that we've done life insurance well into their 70s. Now, it is not the most efficient or the most inexpensive way of doing it. Certainly the earlier, the better. But once you get past age 75, it literally is very, very difficult to get life insurance. I'm not going to say it's impossible. There are some carriers out there that will issue insurance all the way through age 79, but the cost is almost prohibitive, even if you're healthy. So I think that having a constant review with an advisor is extremely important. And people, tend to forget about their life insurance. It's kind of one of those things that you don't think about. You think you have everything covered, but then you realize, oh my gosh, I bought this 25 years ago and it's a term policy and it actually has 5 more years left and there's no conversion. So what do you do? So we get a lot of those questions, and it's best to constantly take a look at those things so it doesn't just go into a file and gets archived for many, many years and doesn't get looked over.
And I'm really glad you guys are covering everything, from 401k to living wills and trusts and, estate planning, all of those, because it does kind of all come together. I just wanted to thank you for this information. Any last words, Jordan and Luis?
Thank you very much for the opportunity.
Yeah, we really appreciate it. We're here as a resource for all PAMS members. So, if you guys have any questions, please reach out. We're here for you.
Jordan, can you put up your slide again with your contact information? Thank you all. And again, thank you for taking the time to be with us tonight.